Hello, I'm Nathan Kubik, and thank you for joining us for the third quarter of 2020 Transform Wealth Capital Markets Outlook. I hope that everyone is doing well and staying healthy. We have partially returned to the office, though we are continuing to social distance and will continue to have virtual meetings. Our dedicated team continues to serve you with the exact same efficiency, systems, and tools as we have in the past. In this outlook, we will be focusing on the current market conditions, economic impacts from COVID-19, the market's response, what lies ahead of us, and how we are positioning. So let's get started. In the third quarter, the equity markets continued their rally, with the S&P 500 and NASDAQ reaching new record highs. Forward-looking economic indicators are improving, and earnings forecasts are significantly higher than most had hoped for just a few months back. Earnings expectations are now greater for 2021 than what was actually realized in 2019. That said, it is important to keep in mind that there are still a number of unknowns related to COVID, to the election, and within different parts of the economy. In this outlook, we will be diving into these factors as they relate to where we are today and where we go from here. This quarter, as the economy began to recover, COVID cases did rise meaningfully in July. This is a combination of there being increased social exposures as the economy reopened, but it was also due to a greater availability of testing. Cases have come down these past couple of months and appear to have stabilized. This is also true for most of the world outside of the US, with the exception of Europe, which has seen a continued rise throughout most of this past quarter. Thankfully, fatality levels do seem to be diminishing, and that trend is also apparent from a global perspective. Moving into cold and flu season, we are carefully watching all of the indicators related to COVID and the healthcare sector as a whole. From a geographic standpoint, the U.S. equity markets continue to outperform the rest of the world. Here, we see that from peak to trough, the U.S. fell less than the rest of the world and rebounded more strongly. This in part is due to the financial strength and stability of the U.S., but it is also due to our country's different sector weightings and the differences in the underlying drivers of our economies. Additionally, while almost all countries provided a stimulus package, there was a meaningful difference with the way the U.S. approached it. The majority of countries around the world stimulated or propped up their economies by lending or giving money to their businesses in order to maintain their current employment levels. This approach differs from the U.S., who did offer PPP funding to smaller businesses, but focused more dollars directly to their citizens. One side effect of this difference is that it forced U.S. companies to pivot their business models to focus on efficiency and new deliverables. I will note that it is yet too early to say which approach will prove to be more economically optimal in the long run. But looking at unemployment rates, we can start to see a picture emerging. We do see that the U.S. initially experienced a significantly greater increase in unemployment than that of Europe. However, we also see a near immediate and significant decline where Europe unemployment levels may be yet to peak. Additionally, while the U.S. companies focused on efficiencies, which hopefully will have lasting benefits, Europe companies have not shifted as effectively. Here we look at the earnings levels of the S&P 500 versus that of the EFA, which is the European index. Clearly, the U.S. companies' earnings are rebounding at a greater pace than that of Europe. This in part is as a result of the different stimulus packages and the need for European companies to maintain their employee level expenses, while U.S. companies have been forced to reposition. Now, while things are clearly improving for the U.S. economy, we're not yet back to the levels we were prior to the pandemic. So how is it that the markets are hitting record highs? Well, it's important to recognize that the markets and the economy are two different things. Certainly over time, they need to be moving in the same direction, but there are times where they will do so at a different pace. The markets are forward-looking, where the economic data is driven by what has happened in the past. Additionally, there are meaningfully different drivers. Consider this chart. Looking at technology and the communication services, which is seen in the darker green, those sectors only drive 6% of the US GDP. They also only account for 2% of total employment. However, they account for almost 40% of the S&P 500 market cap. I point this out only to show one of the many differences between that of the economy and the markets. One economic factor worth noting is that of the total household's balance sheet. On the left chart, we consider total net worth values from 1 year ago against where we are today on the right chart. As you can see, total household net worth has continued to increase throughout this pandemic. This should create some strength to come out of this pandemic more smoothly. On the other hand, the US budget has changed dramatically. As you can see, to ensure the strength of the consumer balance sheet, the federal government borrowing and spending have both increased by more than $2.2 trillion. This does have some meaningful long-term implications, as seen in these charts. The chart on the left shows us federal debt forecasts prior to the pandemic. The chart on the right shows a spike in borrowing that comes as a result of the most recent stimulus package. Questions remain as to whether or not there will be another spike from another stimulus package, or if the flatlining seen in the current forecast is actually a reality. Much of this will be dependent on the outcome of the coming election and the approach taken to address the growing debt levels. The outcome of the coming election is yet unknown. Often, emotions can feed into decision-making for investors moving into, through, and following an election. Counter to what many believe, historically, the outcomes of the elections have not had a meaningful impact to the markets or the economy. With COVID and current economic conditions, there is certainly more going on right now than just an election. Regarding elections, we thought it was worthwhile to show what has happened historically in the first full calendar year following an election. 14 out of 22 times, it was better to have stayed fully invested. 5 out of 22 times, it was better to be consistently contributing to the market during that year. And only 3 of those times was it better to stay on the sidelines. Of those 3 times, the most recent was caused by the tech bubble. While we do have risk mitigating exposures in place in each of our models, we do advise staying the course through this time period. Moving into the market's performance discussion, large cap growth companies have continued to dominate the equity markets, outperforming large cap value by 32% year to date. This has brought growth valuations to a very high level. While not completely unwarranted, we do find many of these valuations to be too high for the current economic conditions. To that end, we are currently positioned slightly tilted towards large cap value. I will note that we are focused on companies within this style that we believe elicit growth-like characteristics, but have value-like valuation metrics. Considering the middle chart, we see that the current PE of the average growth company is 64% greater than its 20-year average. This, of course, is not true for all growth companies, and we are focused on investing in growth companies with more reasonable valuation metrics. Looking at large cap value companies, we see that they are only 26% greater than their 20-year average. It is also important to understand why valuations look so overpriced right now. Ultimately, it's a result of the pandemic and the economic shutdown. Revenues and earnings took a big hit this past quarter, but for most companies, not as bad as we had anticipated. Further, earnings forecasts appear meaningfully stronger than originally expected. So while valuations look expensive right now, if future earnings forecasts are correct, they do have the potential to justify many companies' current valuations. Of course, this is all yet to be seen, but the consensus of analysts are estimating earnings for 2021 to be higher than that of 2019. Looking at the first light blue column, we see the earnings drop that we just discussed. But looking at the second light blue column, we see that estimates are indeed higher than what we experienced in 2019. Should this jump occur, we should justify the current valuation metrics. From a sector standpoint, growth sectors continue to lead the recovery, with technology, discretionaries, and communication services leading the charge. As we've discussed in the past, energy is having its own struggles in addition to that of the pandemic. But interestingly, the value-oriented sectors of financials, real estate, and utilities continue to be the laggards. Looking at this year quarter by quarter, we can see that with the exception of energy, every sector has improved in both the second and third quarter. We also see that there is clear leadership from technology and discretionaries, which are our two largest sector overweights. Interestingly, discretionary is the sector that hotels, restaurants, and leisure reside within, but it's important to recognize that that subsector only makes up 1.68% of the entire S&P 500. Additionally, airlines reside within the industrial sector, but make up only 0.23% of the S&P 500. While these subsectors have been struggling, it's important to keep in mind that they make up a very small portion of the market. Here, we look at our core equity model. As you can see, our two overweights are in technology and discretionaries, the top two performing sectors year to date. Our underweights to energy, real estate, and consumer staples have also served us well throughout this past year to date. Looking at valuations, we see that overvaluations are across the board, with growth-oriented sectors having larger overvaluations than that of value. We believe this has been and continues to be a time period where active management and individual security selection matter greatly. Additionally, due to the unknowns that we've been discussing, we continue to hold some risk mitigating strategies within our equity models. In this core model, we are utilizing a buffer cap strategy and continue to hold some gold. A similar story can be seen in our dividend equity model. Technology, discretionaries, and materials are our overweights here. This strategy has an inherent tilt towards large cap value, and this attribute did drag on this portfolio. That said, like the core equity model, we believe these types of companies have stronger fundamentals, and valuation metrics remain more attractive. We also continue to hold the defensive portion of this model in the buffer cap strategy as well. As we are in a time period of incredibly low yields, the dividends associated with these companies, along with their stronger fundamentals, should continue to look attractive and entice buyers as we move through this health crisis. And in regard to those yields, here we see the U.S. Treasury yield curve at record low levels. Much of the developed international bond markets continue to issue debt with negative interest rates. But according to Fed Chairman Powell, there is no expectation of doing so within the U.S. That said, he has set forth the expectation of low interest rates for the next 2 or 3 years. The drop in interest rates has created a corresponding jump in bond prices, and we believe that now is an incredibly important time for patience and thoughtful positioning. Most interest-bearing securities have appreciated dramatically through this time period. With the exception of preferred equities, which have a different risk profile, each of these types of investment-grade bonds has appreciated meaningfully. This is a time that bond structure, credit quality, and interest rate sensitivity are incredibly important. While there is no impending reason to expect rates to rise, the risk-return trade-off given current bond pricing requires excessive thoughtfulness in bond positioning. As you can see in the chart on the left, the Fed funds rate is now near nothing. Looking at the chart in the bottom right, we see that FOMC estimates and as well as current market expectation forecasts, these rates are to remain near zero for the next 3 years. That said, there are often unforeseen events that create buying opportunities for fixed income with greater yields and lower prices. An event like what we saw in March and April is unlikely, However, there are some areas of uncertainty that could create a less dramatic buying opportunity. The upcoming election is one. Another is the potential for defaults in lower credit quality bonds. This can have a smaller but correlated response in the same type of higher quality bonds. And should the economy boom after a vaccine or treatment is found, that's another. In a boom, money will move towards risk and away from the safety of bonds. There are also many other scenarios that could occur as well. Of course, these are all unknown, and we may not have a buying opportunity, but we do believe that there is no reason to extend duration and increase interest rate risk to chase a tiny bit more yield. Instead, we believe we should be patient, limit our interest rate risk, and reposition as the future becomes more clear. We hope this presentation has been helpful in understanding some of the market's moving pieces. We also hope that we've been effective in showing you some of the reasons for the apparent disconnect between the economy and the markets. In conclusion, while we are encouraged by the improvement in economic data and forecasts, there are still many unknowns, and we are positioned with that in mind. Each day brings us a little more clarity and one step closer to getting through this difficult time. We remain focused on potential risk exposures and are prepared to reposition again should clarity of information shift these exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, please stay safe, and we look forward to speaking with you soon.